the Global View on this Monday. Well, let's take a look at the bigger picture, and US consumer sentiment falling sharply in October as households anticipate inflation to increase to 3.8% over the next year. The University of Michigan's preliminary reading coming in at 63 this month compared with 68.1 in September. And US import prices increasing less than expected in September as a strong US dollar depressed prices of non-petroleum products. Well, US Treasuries rallied on Friday as investors worried about the intensifying conflict in the Middle East. The yield on the 10-year note falling to 4.6% and the 2-year was down to 5.05%. And the US dollar did touch a one-week high against most major currencies, extending gains from the previous session when inflation data reinforced expectations that interest rates will need to be higher for longer. The Aussie dollar trading down at 63 US cents. Well, let's now focus on some stock selection, portfolio positioning, and stocks you can own during times of turmoil. Rob Shears joining us from Valor Private Wealth. Rob, a very good morning to you. Good to catch up with you again. So, of course, we talk about times of turmoil. I've just been speaking about that rising geopolitical risk. So, as a result, are you re-looking at your portfolio there and perhaps adjusting as a result?
We have been adjusting as the markets have been rising over the last 6 months or so. So it's been a gradual adjustment, and not adjusting due to any event, but as we always like to say, we don't like to predict, we like to prepare. And when markets get more expensive, you need to start preparing and be more cautious. As Buffett says, you want to be cautious when others are greedy. And I still think there's a little bit too much greed in markets for where we are in the cycle.
All right, well, Rob, let's get straight into it then. Start with the positive then. Those stocks you see that you perhaps need in your portfolio in these times of turmoil and uncertainty.
Yeah, so there's sort of the 5 stocks that I think are good for this period, and that's the evergreens, the undervalued stocks, the serial acquirers, the cash-rich companies, and the Uber cannibals. And I'll explain those as we go through. So the evergreens are the companies which just pretty much put their revenues up every year and sell more of what they do over every 5 or 10 years, 15 years. They're going to be around almost regardless of cycles and growing regardless of cycles. They're not going to grow quickly, but they'll grow by mid-single digits on average. A lot of these companies can grow at higher single digits if they do well, but for 5, 10, 15 years at a time, and you just know they're going to be steady. So that's the Pepsis, the Unilevers, the Reckitts, the Diageos, and they still have a bit of volatility. Nothing is permanent. There's still always some cyclicality in every single company, but these are less cyclical than almost any other company.
All right.
So the second part. Oh, sorry, go on.
No. You keep going. Yeah, undervalued stocks.
So the undervalued stocks are companies which are just so far under their fair value that, yes, there's going to be cycles. Yes, these companies may be cyclical, but they're so far under their fair value that if you're looking over a 5-year period, you're probably going to double your money regardless of even the cycle. And that's, we've got a couple there in Australia there, but certainly Fiducian is exceptionally undervalued compared to, you have to go back to 2014 to look at Fiducian to get these levels of valuation. It's trading at, I think it's 3.57 times sales, which last time it was this year was 2014, even though it's been one of the fastest growing companies in Australia. Magellan is exceptionally cheap if you look at their assets, not their fund management business. And Albemarle is the largest lithium miner in the world and one of the lowest cost lithium miners in the world. And it is exceptionally cheap. It's trading at sort of mid-single digits price to earnings, potentially 7 or 8 times price to next year's earnings. But it's going to double production in the next 3 years. This is just an exceptionally undervalued business.
Interesting. In fact, we just had that news out this morning. In fact, Rob, Albemarle pulling out of its bid for Liontown. So that's interesting.
It is, yeah. So, I mean, they were playing games there. I think it was probably a fair bid. But, so, they upped the price. So I thought it was a fair bid. I actually thought it was a bit over the value for where it is in this stage of production. But you never know. We'll see what happens. They might come with there's quite a few Aussie players there which probably need a larger partner.
All right, well, let's move to your serial acquirers.
Yeah, so the serial acquirers are sort of like the evergreens. They're just a different business model. These are companies that use their cash flows to keep on buying other smaller businesses. And often what they're doing here is they're taking advantage of the private market to public markets arbitrage. So the private market businesses are usually a reasonable amount cheaper than the public market businesses. And if you raise money in the public markets and then buy private market businesses, you can keep on growing for a very, very long period of time. And Constellation Software, Addvise, which is a Swedish medical devices and a company, and SDI Group, which is a fantastic business in the UK. These are companies that will buy more companies over the next 5 or 10 years, and their earnings will grow almost regardless because they're going to have far more businesses in their stable over the next 5 or 10 years. And the beauty is that during difficult times, the companies they're buying get cheaper, so they can actually accelerate their growth. And that's what's happened to Constellation Software. Last year, when private equity was falling out of bed because they have too much leverage, Constellation Software grew faster because of the downturn. So these are wonderful businesses to have in your portfolio during difficult times.
All right. To the cash-rich ones, we've spoken about this before, certainly Berkshire Hathaway, plus you've got Alphabet as well.
Correct, and Berkshire's cash just keeps on getting larger. So Berkshire's now up to $147 billion in cash. And a couple of years ago, they were earning less than 1% on their cash, and now they're earning 5.5% on their cash. So it's actually increased Berkshire's earnings by nearly 20%. So one of the reasons why Berkshire's share price hit all-time highs quite recently is because, and Alphabet's also doing well and hitting 52-week highs, is because their cash is actually earning more money.
Yep.
So that's a lovely place to be in difficult times. And the final one there is the Uber cannibals. And the Uber cannibals are these companies buying back huge amounts of their own stock. And there's a number of these around the world. A lot of them are in less than exciting businesses or things you probably wouldn't invest in. But when you look at the mathematics of buybacks, these companies, and a company like Synchrony Financial is one of the fastest buyback stories in the world. Last year, they were actually buying back 18% of their stock per annum. They've slowed it down now to about 12 or 13%. But if you can buy back somewhere in the order of 18% per annum and they increase it during difficult times, you're actually increasing your earnings per share by 5 times over a decade. So it's a 5-bagger just on share buyback. So the best thing that can happen is your share price goes down and you buy back more stock. So the irony of these companies is the best thing that can happen is a downturn.
Okay, so they're the stocks you mentioned there that you can own during those times of turmoil, such as now. What are the ones you should be avoiding though, Rob?
Most of the share market.
Okay.
So most businesses in the share market are not very good businesses. If you look at, when they used to list every single company in Australia, really 3/4 of the companies don't have any earnings in the PE column. There's no earnings. So you just got to avoid pretty much most companies. But when it comes down to specific businesses, banks are very difficult businesses during difficult times. And I always like to cite Citigroup, which was the largest bank in the world in 2007 by assets. Citigroup got smashed, and the share price now trades today at the same level it was in 1992. So banks can be very, very, very difficult businesses during difficult times. And so there's not many banks you really want to be owning going into these things. You buy the banks on the way out after they've raised capital, but you do not want to be owning banks going into a potential difficult period.
Interesting, because we just had the result too from Citigroup on Friday, but we saw the larger banks there beating estimates, but still you're obviously wary of being there.
Well, I think the US banks, their capital levels and what their loans are far less risky than they were. And I don't think the US banks are as bad as a lot of the other banks around the world because they did have such difficult times only 15 years ago. So I think that there's other banks around the world which haven't had cycles over the last 30 years. And they're the ones you need to be worried about. Obviously, the Aussie banks haven't had a cycle for 30 years, since the 1990s. That's early 1990s. So, the highly leveraged companies, Evergrande is the poster child. I wrote a blog in 2017 warning about Evergrande. and it only took until last year to blow up. So, but Evergrande was so obvious that it was one of the dumbest and most leveraged companies in the world in 2017. It went up 4 times after I wrote that blog, obviously, but yeah, you just don't want to be in highly leveraged businesses going into cycles like this. And they're hard to pick, but once you get trained in the art of avoiding frauds, fads, and failures, you can see lots of red flags in a lot of companies, and avoiding these companies. And obviously, we know that Madoff survived until the GFC. His fraud was able to hide and paper over his losses until the GFC, and then he got exposed. So, you only know he's been swimming naked when the tide goes out.
Yeah.
And that's what you want to avoid. These seems too good to be true businesses and stocks and people. So that's.
And Rob, you also mentioned there avoiding capital dependent companies. You've got a good example there in Rivian.
Yes. So companies which require further capital raises, they are dependent on the kindness of strangers. These are just companies you cannot own during the full cycles. A semi-cycle, which is where the share market just goes up and down a little bit, is not a. Hold on, sorry. Are you there?
We still got you. Yep. You
So
carry on. We can hear you, Rob. Yep.
Yeah, fantastic. So frauds, fads, and failure. Sorry, capital dependent companies where they raise the money during a downturn. If the share price goes down 90-95%, you are wiping out your future returns for the next 5, 10, 15 years. So you just can't own those sort of companies. And Rivian has a lot further capital raises to come. So you just can't own those sort of businesses. Consumer discretionary, and that includes the TVs, the cars, all those sort of companies. You just want to avoid them. Property developments. If you look at the US property development companies, a third of property developers go broke every 10 to 15 years. So these are difficult businesses, and Australian property developers are having a very difficult time at the moment. Highly cyclical businesses like miners, they have very, very difficult periods. So the lower end of that, those things, you can own the lowest cost producers of these companies, but you can't own the higher cost producers of. And you look at the uranium stocks are having a bit of a renaissance right now, but after 2011, pretty much every uranium stock went near zero after the 2011 Fukushima period, and the only one that didn't was Cameco in Canada. So you've just got to avoid the low end of the mining company spectrum.
Yep. Shopping
centre stocks, I think they've got further pain ahead. Office REITs is the probably the worst area I think you can have your money right now.
Okay.
We are in the first innings of the downturn in office REITs. Companies still are yet to consolidate their office with work from home. And obviously low margin businesses like restaurants, you've just got to avoid those sort of companies going into what potentially could be a coming downturn.
All right, Rob, we're pretty much out of time, but you got through that comprehensive list. Hey, thanks so much for joining us from Valor Private Wealth.
Thanks, Andrew.
All right, that is the Global View. Stay with us. The Open is next.